series, where we'll discuss how you can better prepare to fund college education, minimize taxes, and plan for income and retirement transferring wealth. We certainly appreciate all of you taking the time to join us today. A few items to go over before we get started. First, please note that in order to ensure everyone has the ability to hear the information presented by our guest speaker, everyone will be on mute during the webinar. Second, please feel free to write in any questions you have using the Q&A tool on the webinar menu. And at the end of the webinar, we will take some time to go through these questions. Now I'd like to introduce our guest speaker of Putnam, William Cass. Mr. Cass is the Director of Wealth Management Programs at Putnam and is responsible for developing and delivering wealth management-related content, educational programs, and marketing initiatives. He speaks regularly throughout the country to groups of financial advisors and investors on a wide range of financial planning topics, focusing on areas such as effective retirement income strategies, tax legislation, developments, personal risk management, and efficient wealth transfer. Prior to this role, Mr. Cass held various positions within Putnam Investor Services and corporate marketing. Mr. Cass currently holds his FINRA Series 6, 7, 26, and 63 licenses, and is a certified financial planner professional. He has been in the investment industry since he joined Putnam in 1990. Thank you for leading us through this webinar today, Bill, and now I'll turn it over to you.
Great. Thanks, Tori, and thanks to everyone out there following along. We're going to cover a lot of ground today across the financial planning spectrum. So we're going to spend a little bit of time on college funding. Then we're going to shift focus to taxes, everybody's favorite topic. And then we're going to wrap things up with talking about retirement, especially income in retirement, and wealth transfer. One thing I'd note is that everyone's situation is unique, so everyone needs a unique plan. For today, it's really about coming away with a few considerations that you might want to explore deeper. For example, working with a financial advisor or a tax professional or an estate planning attorney. So that's really the focus and goal for today. Now let's get started here, and let's talk about funding college education. And certainly, if you look at the numbers, they're alarming. If you following along on the slides here, college costs are rising. So these are projected numbers if we just assume that college inflation rate on those types of expenses will continue at the rate of about 5% a year. This is what it's going to look like almost 20 years down the road. And what I would say is don't let the numbers scare you too much. Okay? The numbers are huge. It seems like just a huge task to try to fund college education, but the important thing to remember is to start the process as early as you can, and however small that is, and be consistent over time. Okay? Now we're looking at the fact college debt is obviously rising. You would expect that with the cost of college increasing so much. I think folks need to think about a three-part process for tackling the college funding challenge, if you will. You know, maybe part savings and current resources packaged with loans, and then including scholarship money. There's a lot of scholarships available, grants, or even things like work study on campus. So I think that's the way you have to approach it versus trying to fund that whole amount. And I'd say even with the statistics of the college costs rising and the debt, for many, college is still a very, very good long-term investment when you look at the differential between, for example, starting salaries and also lifetime earnings for college graduates versus those that do not graduate for college. So I do think that over the long term, it's still a very, very good investment. Now, how do we save for college in the most effective manner? For many people, that's going to mean a 529 college savings plan, which have really become popular in the last decade or so. Lots of different advantages there. For example, tax advantages. These are funded with after-tax funds, but once the account is funding, There's no taxes on growth inside of the account, depending on what you're investing in. And there's no taxes when you take the money, assuming that the user for qualified higher education expenses. There's control, meaning that the owner, which would typically the parent, or don't forget about grandparents, can control those account assets. They can change beneficiaries. There's a lot of flexibility. Anyone can contribute, so that's always a good idea to get the whole family involved. Now, if you look at 529 college savings accounts versus, for example, people have historically used custodial accounts, unified gifts to minors, or unified transfer to minors accounts. One of the issues with these accounts is that once that minor, the child, for example, reaches the age of majority, they assume full control over that account. So the parent, who is the custodian, loses control at that point. But that doesn't happen with a 529. So the control is a big, big aspect in addition to the tax benefits as well. So let's shift gears a little bit. Let's talk about taxes, minimizing taxes. And where do we stand right now? Here are some key tax figures for 2014. Looking at the highest marginal rates for ordinary income for wages, also investments. And you notice, for example, the ordinary income tax rate on investments, for example, CD interest or bond interest, is a bit higher than your wages, for example. And that has to do with the fact there's a new 3.8% net investment tax on certain investment income associated with the Affordable Care Act. So for people at higher income brackets, they might be paying an extra 3.8%, for example, on bond interest, dividends, or capital gains as a result of the healthcare reform law. You see dividends and capital gains at 23.8. That's including the 3.8% Medicare surtax. And then lastly, for folks at higher income levels, it's not just about higher tax rates potentially. They will also face a higher tax bill because of phase-outs of itemized deductions and personal exemptions. So, for example, without getting into all very complicated tax topics, at higher income levels, folks that are writing off mortgage interest, for example, will start to see that deduction reduced because of their income level. So that will obviously also contribute to a higher tax rate. The good news, I think, now is that for most people aren't affected by these higher tax rates because it only affects folks at higher income levels. But we have to look forward to the future. And when we're thinking about taxes in the future, you really have to look at government debt in other factors as well. So what we're looking right now is total U.S. government debt as a percentage of our nation's output, our gross domestic product. And the percentage, these figures here are the highest they've been since coming out of World War II. So what we see here is this begs the question with a deficit issue, how likely is it that taxes will go up in the future? And I would say that is certainly a risk. So people have to be thinking about that, not just where taxes are today, but where they're going to be in the future, considering some of these challenges at the federal level. Staying on that theme, one of the other areas to think about is the demographic shift that in our country we'll have a much higher percentage of folks that are age 65 plus. Those folks will be getting Social Security. Those folks will be receiving Medicare benefits. So those are the two biggest government programs out there, and there likely will have to be changes. Could be higher taxes in the future in order to address that. The fact that on average more people will be receiving these types of benefits. On taxes as well, I mentioned the new health care taxes. Again, for folks that are above $200,000 as an individual or $250,000 as a adjusted gross income as a married couple, above those levels, they're going to pay a higher payroll tax, a little bit extra in Medicare payroll tax. And then they're also subject to this Medicare investment income surtax of 3.8% I mentioned. So above those income levels, whatever tax rate they're paying on interest, dividends, capital gains, rental income, they're going to have to add an extra 3.8% on top of that. The good news is that money coming out of retirement accounts and IRAs, or also if you're converting from a traditional IRA to a Roth, that income or income from municipal bonds are not impacted by this new 3.8% tax. And then lastly, wrapping up taxes, talking about alternative minimum tax. This is a very complex topic, so if you're subject to it and have detailed questions, you'd probably be best off talking to your tax professional. But people at higher income levels are more likely to pay AMT. Alternative minimum tax is basically, folks may not realize it, but when you're figuring out your taxes, you're also at the same time figuring out alternative minimum tax. It's a tax calculation going on a parallel basis. So if you think about it, there's two different calculations going on with two different rules. And basically, you're going to pay whatever the highest amount is. So, for example, I can write off my children. I can write off my state and local property taxes, my state income taxes on my regular tax return. For alternative minimum tax, I cannot do that. So those types of tax breaks aren't factored in. So it's a separate tax system. It's a parallel tax system with different rules. Now, avoiding or minimizing the AMT. Again, your best bet is to talk to your tax professional, but for example, municipal bonds, certain municipal bonds that are income tax-free might not be tax-free when you're subject to AMT. Those are called private activity bonds. Exercising certain stock options could increase your chances of being subject to AMT. Realizing large gains, large capital gains may push your overall income up higher to where you might be subject to alternative minimum tax. And then, it might make sense, for example, if I can't write off my local property taxes, if I know I'm going to be subject to AMT, I might want to delay my fourth quarter payment to the first quarter of the following year to push that deduction into the next year where I may not be subject to AMT. So there's some food for thought there, but again, this is very complex. I'd really suggest that you talk to a tax professional when discussing alternative minimum tax. Taxes on retirement plans, it's important to remember that when you look at that statement, your 401k statement or your IRA statement, to remember that at least, generally these are funded with pre-tax dollars, so you have to account for the fact that when you take money out in retirement, you're going to pay federal income taxes. So that could be, 30 cents on the dollar, could be almost 40 cents on the dollar. So that's something to keep in mind, that the government, when you take your money out in retirement, the government's going to get their share as well. So that has to be taken into account in terms of how much you're saving for retirement. That's why a lot of folks have thought about also saving in Roth accounts, whether it be Roth IRAs or converting from a regular IRA to a Roth, and probably not for all your retirement money, but for maybe a portion of your retirement money. It might make sense to have some of your retirement money in a Roth where when you take it out in retirement, it's tax-free. One of the other benefits is the government doesn't force you to take money out of a Roth if you're the owner or the beneficiary spouse. You can avoid required minimum distributions. So that's another aspect. So again, I think there's a notion of there's a benefit to having some money of your retirement money in a Roth, maybe not all of it, but some, so that if tax rates are higher in the future or your personal tax bracket's higher in the future, you at least have a bucket of money to draw from in a tax-free manner in retirement. So let's segue into the last part of our conversation today. It has to do with retirement and transferring wealth. And we're going to focus on not saving for retirement really, but more focused on planning for income in retirement and what are some of the risks and concepts you need to be aware of. So one of the areas that you need to be aware of is longevity. This is the big unknown. When you're saving for retirement, you at least have a ballpark idea of what your time horizon is. You know, maybe you're thinking you're going to retire at 65, you know, you're 55, you're 10 years off. That might change a little bit, but it's probably a good ballpark. What happens when you retire at 65 and now you change the focus to retirement income, and longevity comes into play, meaning that it's a totally undefined time horizon. You might live 10 years in retirement. You could live 40 years in retirement. Who knows? Okay, there's just the uncertainty is what is the biggest challenge for people retiring. So the longer your retirement, obviously, the more savings you'll need just to cover basic expenses in retirement. This is the chart you're looking at today, based on number of years in retirement. For example, especially a couple age 65, there's more than a 50% chance that one of those spouses is going to live into their 90s. So even if one passes away earlier, before the life expectancy, the odds are that someone's going to live in their 90s, and you have to prepare or try to prepare for 25 or at least 30 years in retirement, and making sure your portfolio can last that long. So how do we do this? One of the ways to do this is to make sure that you're being prudent and conservative about around how much you withdraw in retirement. So here's an example about choosing the right withdrawal rate. So we're really assuming that we have a hypothetical portfolio, and that it's invested roughly half in government bonds and half in stock with some cash in there. So let's call this a balanced portfolio. So if you can see, if we're taking out 3% each year, that's my withdrawal rate. And by the way, we're assuming you're going to increase that a little bit each year to keep up with inflation. That portfolio is going to last 50 years on average, based on historical results going back to 1926. On average, it's going to live, or with a 95% confidence threshold, it's going to survive 50 years. So if you're taking 3% out a year, I think you're going to be okay. But look at what happens if you're withdrawing 6%, 7%. Those figures go down dramatically. So this really, for people who have heard about the 4% withdrawal rate, it's usually a pretty good rule of thumb. You know, 4 or 5, sticking with a withdrawal rate of 4 to 5% will typically make a lot of sense. And obviously, you're going to adjust that as you go as well. There's another way of looking at it, and now we're looking at different investing options. So again, this is the same historical data going back to 1926. In this chart, we're looking at different portfolios: a conservative portfolio, balanced, and a growth. In over 20, 30, and 40 years, how long would, what's the probability over that period that that portfolio would have survived, meaning that you wouldn't have run out of money? And we're assuming you're going to take 5% out each year, and you're going to increase that a little bit each year to account for inflation. So if you look at over 20 years, all those portfolios do pretty well. In most cases, you're not going to run out of money. But as you go out 30 years, look at what happens to the conservative portfolio in 40 years. And it has to do with the fact that if you're too conservative in retirement, it's being too much in cash and stocks, at least based on historical results, that you haven't been able to keep up with inflation as well. On the flip side, you want to be in a growth portfolio where you could realize another 2008, 2009 all over again. Probably not a good idea either. So the point is this: we're not trying to give specific advice, but work with a professional to determine, you know, what asset allocation makes sense for you, with the notion that you need to at least have some type of long-term focus. Because what if you live 30 or 40 years? That you're going to need to have some investments within your portfolio that can keep up or hopefully exceed inflation. Now back to taxes for a second, and when you're in retirement, one of the ways to make your portfolio last longer is not just about withdrawing the right amount and about asset allocation. It also comes down to being as tax smart as possible. So there are a whole different type of income types and their taxability. So to what extent you can be smart about withdrawing money in retirement or accessing money in retirement in a tax-smart manner, that makes a heck of a lot of sense. So, for example, if you're in a high tax bracket one year and you have a Roth account, you might want to withdraw more from a Roth that year because since you're in a higher tax bracket, having that option or that flexibility. One of the other concepts with being smart about taxes, especially when we're talking about how do we smartly transfer wealth to the next generation, is what we call a stretch IRA. And the concept here at a high level is, with a stretch IRA, you want to be sure with your IRA that you've listed a beneficiary and also have contingent beneficiaries. That's where it all starts. And you want to make sure you review those on an annual basis to make sure you're not running into any mistakes as your life changes. So the notion between around a stretch IRA is that when that principal owner passes away, leaves it to their spouse, for example, in a lot of cases, their spouse could take that IRA as his or her own and continue that account. Now, what happens when the last surviving spouse passes away and leaves it to, for example, the kids or one of the children? And that's where you get this concept of stretch IRA. Now, that child, obviously, that beneficiary could take all the money out of the IRA and put it in their bank or spend it or invest it. The problem with that is that they're going to pay a huge tax bill. A smarter option might be to, instead of taking all the money out at once, to stretch those distributions over a long period. So that beneficiary, for example, the adult child, has the option of withdrawing money. They're going to have to take some money out. The government makes you do that once money is left to a non-spouse beneficiary. But they can take it out based on their life expectancy. Their life expectancy is higher, meaning they are younger. Then they will only have to take out a smaller amount each year. So to what extent you can just take out that required minimum distribution each year, there's based on a lot of different examples, this being one of them, it can show you over the course of many, many years that you can take a little bit out of the IRA that you're required to do, but leave the rest in to grow on a tax-deferred basis. So what it ends up doing, if you can stick to that program, is creating a lot of income over multiple, maybe even multiple generations, or at least over a couple of decades. And then lastly, we're thinking about estate planning and talking about wealth transfer. The question here is, do you need an estate plan? Okay? The answer for everybody is yes, and I think this is where people make some mistakes. They think about estate planning and they think about it in terms of how much wealth and how much assets they own and how much wealth they have and whatnot. So folks that are more modest of wealth might be of the thinking that they don't need an estate plan. That's just for very wealthy people. The good news with the current federal estate tax law is that if you have assets under, let's call it around $5 million, so that's your total net worth, your taxable estate, or as a couple under, let's call it a little over $10 million, you don't have to worry about the federal estate tax. So most people don't have to worry about that tax. For people that are above those levels that have considerable wealth, they need to talk to a estate planning attorney to look at options in order to maybe mitigate the effect of federal estate taxes. But for people that are under those levels, meaning that they're not going to have to pay any federal estate tax, I think one of the biggest problems is that a lot of folks don't think they have to do any estate planning. Whereas with estate planning, the estate tax, the federal estate tax, is just one piece of the puzzle. A whole focus of estate planning is how can you transfer assets efficiently, either to family members or charitable entities or based on your wishes. So, you know, I think everybody needs at least some type of estate plan. Do you have the fundamental documents in place? Do you have the right beneficiaries on your retirement accounts, your insurance policies, your annuities? Do you have a power of attorney so someone can make decisions for you if you're incapacitated, or some type of health care directive, for example, a health care proxy, to make decisions around health care for you if you aren't able to do that? Maybe a revocable trust in order to transfer the ownership of an asset from one generation to the next much easier versus going through a costly and timely probate process. So there's a whole host of considerations here around estate planning that has nothing to do with the estate tax bill, if you will. So it's important that at least you have these basic documents in place. For example, a durable power of attorney, healthcare proxy, wills I mentioned, and then revocable trusts. Irrevocable trusts for folks that are looking to gift assets long-term and remove assets from an estate. But again, with all of these topics, you need to talk to a professional. So lastly, what are the next steps wrapping up our conversation today? Again, we covered college savings, we covered taxes, and then we also talked about income planning, retirement, and wealth transfer. So we covered at a very high level a wide range of financial planning topics, if you will. This conversation today, or this discussion today, really is about thinking about your personal situation and looking for opportunities to improve, whether it be funding college education. What can you do to be a little bit more tax smart? So there's a whole host of very, very specific ideas here. And again, I can't say it enough. The important thing is to make sure that you seek out professional help, whether that be from a financial advisor, a tax professional, or in the case of estate planning, a qualified estate planning attorney. Thanks so much for joining us today, and good luck as you plan for your wealth. Thanks so much.
Thank you, Bill. We appreciate you sharing your time and knowledge with everyone here today. We will now start addressing some of the questions that have been filtering in. Please remember that if you have any questions, you can submit them using the Q&A tool on the webinar menu. And as always, you can reach out to your dedicated service team at Pensionmark for any plan-specific questions. It doesn't appear that we have any questions at this moment, and so this will conclude our webinar session. Again, thank you, Bill, and thank you, attendees, for your participation. I hope everyone has a great day, and we look forward to our next webinar series with you. Take care.